A statement of cash flows is one of the trickiest sections in grade 12, but actually one of the easiest once you come to terms with it. It is something completely new and unlike anything else you've done, but it really doesn't need to be that difficult if you understand it. A statement of cash flows is very important for companies as it's one of the financial statements that need to be published alongside your statement of income and statement of financial position. And what it does is it shows how cash was generated and used in the business. In other words, where the money came from and where it went to. And this is important because cash flow is important for the survival of any business. Any business that makes a lot of profit but can't actually pay their debts as they become due is eventually not actually going to survive. So it's vital for a company to understand how its cash is being used. It's made up of three main parts. The first is the cash flows from operations. By operations, we mean the activities of running the business day to day. So this is all the short-term stuff, the current activities. In other words, we'll use the profit from the statement of income and we'll look at the working capital changes. In other words, changes in your current assets and your current liabilities. For the investing activities, you'll use the cash flows from changes in non-current assets, because that's where you would invest your money. You would invest in the land and buildings, etc., etc. So investing activities, you'll use the non-current assets in your statement of financial position. The cash flows from financing activities is also long-term. It's looking at where did the money come from. So it might have been from the owner and invested as equity in the business, or it might have been borrowed. So non-current liabilities and equity are both looked at over here. T accounts can be incredibly useful for helping you to see what the changes in these items were and therefore what is the effect on bank. Because the cash flow statement, as I've said, is looking for changes in cash. In other words, you're looking for the bank figures in every single account. And the way that you'll do that is you'll use the statement of income information and you'll look at your statement of financial position at the beginning and the end of the year, and you'll look at how it changed. What were the movements during the year? So recreating T accounts is an incredibly useful tool, and I'll show you a number of them over here. The first is when you're calculating your interest, your tax, and your dividends paid. These are shown on the face of the statement of cash flows, below your cash generated from operations, which you would basically get doing a reconciliation note with your profits and adjusting for non-cash items and interest and looking at your changes in working capital. However, then we also need to show the interest, the tax, and the dividends on the face of the cash flow statement rather than just somewhere else in a note, because this is what the stakeholders are going to be interested in. The lenders want to know about the interest, the SARS would want to know about tax, and the shareholders would want to know about the dividends. And so we show on the face of the cash flow statement these items, but we don't show the amounts for the year. We look at only the actual amounts paid. In other words, the bank figures. Using T accounts will help a lot. What you do in the T accounts is you show how much is owing at the beginning and the end of the year, and then you show the amount for the year, and your missing figure will then be the bank that you're looking for. So let's have a look at how we do this. In an interest account, remember that interest is an expense, and so it would make equity smaller, and therefore the bank entry would be on the debit side. When you start at the beginning of the year, you would have had a reversal if there was any accrued interest from the accrued expenses account, and of course that being an amount that is owed to others and a liability would have had a credit balance. So when reversed, it'll come in on the credit side of the interest account. Any adjustment that is made at the end of the year for interest still owing would obviously be a debit in the interest account. The amount that is shown in the statement of income as the actual expense for the year is your profit and loss figure. and then you can work out bank as the missing amount. And that is what would go on the statement of cash flows. Similarly, we can draw up a SARS income tax account. Now, this is probably the most important of all three of these, because SARS doesn't always have a credit balance. Sometimes the balance might be a debit if for some reason you paid more provisional tax than you needed to and a refund is due. So if you're trying to just work it out logically, which can be done, it is very easy to get confused by, do I plus, do I minus, depending on is it a debit or a credit balance. When you do it as a T account like this, it's much easier to just go, okay, well, if it was an amount at the beginning, put it at the top. If it was owing, it's a credit. If it was a refund due, then it's a debit. And you do the same at the bottom. So that's how you would enter in your balances. Obviously, the tax for the year is the amount that is shown on the credit side, because that increases your liability to SARS. And then the total amount paid during the year that would have been to pay off the beginning balance as well as any provisional payments would be the bank figure that you would use. Lastly, your shareholders for dividends can help you to work out the dividends paid. In the same way as we've done before, you'll show your balances at the beginning and the end. In this case, they will always be credit, so that's very easy. You would show your total dividends for the year, unless you want to also go and add on your interim dividend, but that just gets complicated. It's easier to assume that interim dividend will actually go through the shareholders for dividends account. So show your total amount of dividends for the whole year, both the interim and final, or if you're looking at your retained earnings note, it would be the paid and the recommended. That would then give you your total bank as the missing figure, which would be a combination of paying off what we owed last year and the interim dividend in reality, because of course the final dividend would have only been declared and not yet paid. If they happen to tell you what the interim dividend actually was, then you can take a little shortcut, because then, as you can see over here, you just need to use what was the balance owing at the beginning, because that was the amount that was paid off, and the amount of the interim, and you just add those two together, and that gives you your dividends paid. Tangible assets, as you know already, is one of my favorite things to use T accounts for, because it can get very complicated. In the cash flow statement, it's useful to do one lump sum for all the tangible assets at their carrying value. In other words, we put the cost and the accumulated depreciation of all your non-current assets, other than obviously your financial assets, together in one account. And the reason for this is that the total tangible assets at carrying value is the amount that would have been shown on the statement of financial position. And if you don't do it like this, then it's a little bit tricky, because you won't be told how much are the individual items. So you can do it as a little T account, or you could recreate the tangible assets note with the beginning amount, the movements, and the end amount. That would also work. So obviously you put in your balances at the beginning and the end on the debit side, because it's an asset, and assets increase on the debit side. You would then put in any other information that is given. Now, any of these amounts that I've shown in blue here, the new item bought, the item sold, and the depreciation, any of those three might be a missing figure that they want you to work out. So put in whatever you are given as you are given it, and then work out the missing figure, which you can then use accordingly. Obviously, the cost of a new item would go into the statement of cash flows as additions of new non-current assets, or whatever you want to call it. When you sold something, you would show that as proceeds from the sale of a non-current asset. Note that in the cash flow statement, you would also need to take into account any profit or loss. Technically, the profit or loss isn't really examinable, but there's always 2% in the paper that the examiner can ask anything they like. And I have actually seen it come up in one of the recent SUP papers where there was a loss on the sale. So just keep that in mind, that this amount here is the carrying value, and you would then need to adjust for the profit or loss to get the amount in the cash flow statement. Depreciation, you might need to add to your recon note as a non-cash item. And of course, if there's a profit or a loss, you would subtract or add that also, because it would also be a non-cash item. You combine all your cost and ACDEP in the same thing, as you can see. So these balances, remember, those are the totals on the statement of financial position. You can then go and calculate also the new or the sold for investing activities that you would put in the statement of cash flows. And then the depreciation, as I've mentioned, goes in the recon note. Another useful T account is to do an appropriation and retained earnings combined account. In other words, show everything that increased or decreased retained earnings for any reason. Normally, we would show quite a lot of it in appropriation and then close appropriation after retained earnings. It's much easier to just do it in one account. So your opening and closing balances would simply be your balances in retained earnings on the statement of financial position. If you're given profit before tax only, you can obviously put profit before tax in on the credit side as it increases equity, and then you would show the tax coming out on the debit side. However, if they give you profit after tax, you can then combine the two of them and just show the profit after tax. Just make sure that you note that so that you remember you don't need to show tax there. You can show dividends, obviously will come out on the debit side because that is the payments to the shareholders that will reduce the profits that are kept in the business. And if you had a buyback, remember that the average share price would come out of the capital account. And so therefore the extra will come out of retained earnings. That's one that you're just going to need to keep an eye on. The last thing that I can show you over here for your cash flow statement is when you are doing changes in debtors and creditors. These can be quite complicated because there are a number of figures that go into it. The easiest way to handle it is look at your receivables or payables note, if possible, if they've given it to you. Keep in mind that you've already calculated interest, tax, and dividends paid. So any numbers relating to those items need to be excluded because you've already used them. So accrued interest, the balances for SARS income tax, and the balances for shareholders for dividends get excluded. If you've got the note in front of you, you can actually take a ruler and a pen and literally cross them out. Once you've done that, retotal to see what your new totals are, and then you can work out the comparison of did the other debtors and creditors increase or decrease. That's the easiest way of including all the amounts that you need, because the total receivables would be obviously trade debtors, but it would also include accrued income and prepaid expenses and maybe SARS VAT refund due, any other items where money is owed to you that is not your SARS income tax. Similarly, the payables, you would need to use trade creditors as well as any other accrued expenses, not accrued interest, but any other accrued expenses. You would need to use income received in advance. If there was SARS VAT or SARS PAYE that is owed, it would need to go in. And maybe you would also have things like creditors for salaries, UIF fund, pension fund, etc. All of those things, they all need to be taken into account. And that's why I say doing it in the note is really the easiest way of doing it.